And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Rare protests broke out across China over the weekend as groups of people vented their frustration over the zero-COVID policy. What is next for China? Is it going to reopen or is it going to shut down? Here to discuss, Brendan Ahern, Chief Investment Officer for Crane Shares, who runs the Crane Shares China Investment ETF, China Internet ETF. Ben Slavin, Global Head of ETFs at BNY Mellon, and Matt Bartolini, he's the head of Spider America's Research at State Street Global Advisors. Brendan, let me start with you. Bulls argue these protests are going to hasten the process of reducing lockdowns and increasing vaccination levels, so they're optimistic. But I get bears arguing to me that more targeted lockdowns are going to continue regardless of the protests. So what is your position? What are you telling people?
Well, certainly we've seen zero COVID evolve into dynamic zero COVID. So the government's been moving away from the very strict, the lockdowns right back in the spring with Shanghai. At the same time, they need a balancing act that they have a large segment, particularly their elderly population, is unvaccinated. So they don't want to hurt the economy. At the same time, they want to protect these this older generation. So I think the protests only accelerate the opening up process. You just have to move forward. The government's not tone deaf to what the population is saying.
Yeah, and the investing public seems a little confused about this. I watched China overnight. Hong Kong was down 1.5%. Shanghai was down 1.5%. Yep. A lot of big names were down, and yet we open here. China stocks are all up. Your K-Web is up 4% this morning. There's the Hang Seng. That's the close over in Hong Kong. I don't know. It seems a little confusing. They're not sure what to do with this.
Well, I think the key read is that within the Shanghai and Shenzhen, which is 95% owned by investors in China, is that you have all of the reopening trades were up. Restaurants, hotels, airlines were the top performing subsectors. And then this morning you have Pinduoduo, the big e-commerce company, absolutely crushed their Q3 financial results. Adjusted EPS was twice what analysts expected, as well as you have the PBOC on Friday after the close, cutting the bank reserve requirement ratio. So some more support for the financial market. So I think you see a little bit of a pivot here as China gets back to business post-party Congress.
You know, Matt, you have the Spider S&P China ETF, GXC. It's down 30%. Everything's down 30%. Yeah. K-Web's down 30% this year. There's been a big debate this year in the investment community and in the ETF community about how to look at China as an investment itself. At the very least, political risk seems a lot higher than we thought it was going to be 3 or 4 years ago. Is China becoming a sort of separate asset class? I'm trying to figure out how should we be looking at this, given all of this obviously increased political risk that we're seeing?
So I don't think it should be a separate asset class, but I think you can view it as a disparate, sort of separate allocation within a portfolio and trying to gauge your EM interest and your emerging market allocation. And, perhaps going tactically overweight or underweight China based on your current views. I think when we talk to investors and they're trying to make a case for China within their allocation, there's sort of two aspects that I would look at right now. One is valuations, because the market is down so significantly, down 30%. Valuations are relatively constructive versus broad EM as well as versus just the U.S. or broad global equities. And the second part is liquidity. It is one of the few areas of the marketplace where central bank liquidity is increasing, given the fact of the rate cuts by the PBOC, where the rest of the world we're still going through rate hikes. So the valuation liquidity argument could make it as a standalone case for an allocation, not as a standalone asset class right now. But again, that's a huge contrarian play right now because of all that elevated macro risk. Forecasting that out, I think, is going to be inherently difficult, and that's why you have cheap valuations.
Yeah. I'm going to ask you the same question, Ben. Has the situation in China changed the way we should view global investing? So years ago, we assumed, all of us, when I did these ETF shows, investors should own their allocation of the world based on market capitalization. So if China is 15% of the market capitalization of the world, for example, then you should own a fund that represents 15%. And yet a lot of people are now in the last few years, given what's going on politically in China, have questioned that, saying this may not be the only way we should look at this. There are other viewpoints that have emerged about this from what I call the strict, we invest by market capitalization and we don't care where it is, to, well, maybe we should reconsider and look at other metrics. Does this matter at all in the discussion?
Yeah, our clients are really struggling with how to play this market. And, one of the things that's available now versus, a long time ago is really the amount of choice you have in the ETF market. And that choice also creates a predicament as to how to position yourself in these markets. Right now, there's close to 50 ETFs that one way or another track China. And it's very important for investors really to look under the hood, which is one of the really great features of ETFs, to understand what you own, because the performance differential, what those ETFs hold, and the risk that investors are undertaking is very different depending on which one of those products you're in. But historically, they've been underweight China. But here, again, it's been a kind of a struggle, and we're seeing mixed messages from our clients.
Well, I have to say, I'm much more aware of this argument than I was 3 or 4 years ago, Bob. You can't just look at market capitalization. Then I get the value guys. The value guys, they don't care about any of this discussion. If it's 15 times forward multiple or less, I'm a buyer. If it's more than that, I'm a seller. There's sort of like mechanical value guys that don't, Bob, you can debate the politics all you want. We don't care. We know we're value people. We know where our entry points are, and we get in and out. And that's another way of looking at the whole.
I think another way, too, is that on a market capitalization basis, and the market cap weighted indices are great for their use case as asset allocation tools, but they somewhat are different in how global GDP is generated. So they're much more geared towards U.S. equities, if you think on a global basis, where global GDP is actually more further, to the east, and you get more sort of global GDP generated in areas like India and China that are represented within market cap weighted indices. So sometimes instead of using just a global market cap weighted broad-based index, we say divvy it up and sort of try to reallocate a little bit more towards international stocks to be more reflective of how global GDP growth is generated. Problem with that is if you had done that in the last 10 years, you've really lagged that broad-based benchmark because U.S. equities have been so powerful. So it goes back to the valuation case where value stocks are international stocks right now. Value stocks are Chinese equities, but sometimes things can be cheap for a reason. So you need to look for sort of increasing profitability alongside that valuation. Sort of developed ex-US seems to be a better fit.
Sounds like quality, you're going for it.
Well, I think one issue in this debate is that, if you look at MSCI emerging markets and MSCI China 10 years ago, 50% of those benchmarks was financials, energies, and materials. So at the start of a decade of growth decadence investing, the big blob benchmarks were basically value proxies. And so this China's underperformed. No. Within MSCI China, do you know how much was in tech 10 years ago? 2%. That 2% did 2.5 times the performance of the S&P 500. So I think that's part of what we've tried to do at Crane Shares is give you really exposure to those growth elements within EM and China, which the broad benchmarks have really failed to deliver you.
China is an example of the value underperformance that happened here in the United States as well.
100%.
Yeah.
And if you had exposure within your EM or your China sleeve to those growth segments, you ran circles around the S&P 500. You just didn't get that buying the blob, buying the big beta proxy that you paid nothing for it, and so you got nothing in return.
So let me, so you're the China expert here. Let's go 30,000 feet. What's your best guess what happens here going forward? I mean, Xi Jinping, the guy in charge of China, is in a real dilemma right now. Yeah. If he essentially starts opening up, how can he do that without mass vaccination? I mean, he's really exposing the population. This is a very hard decision. They can't really keep locking down the country forever, but they're woefully unprepared, essentially, to open up. How do you get mass vaccinations, or am I keying on the wrong idea here? It seems like they're woefully undervaccinated.
No, I mean, they've said the things they need is they need enough hospital beds, they need enough drugs in storage, and they need to a lot more effort in getting the elderly vaccinated to fully move away from dynamic zero COVID. At the same time, they can't afford to hurt the economy. So I think it just accelerates this path toward reopening. And zero COVID is never officially going away. I mean, that's never going to be admitted that this was
because it's kind of part of the official doctrine, and they can't backtrack on official doctrine. They can only evolve the doctrine. I'm not putting words in your mouth. That seems what's going on here.
Yeah. Right? I mean, it's never officially going away. It will slowly recede into the background. and slowly disappear. I just think what's happening right now with these protests only accelerates that trend.
Yeah, yeah. Any other thoughts on China?
Yeah, I would say it's a very tricky situation that China finds itself in. But again, on top of what's actually happening on the ground in China is really the macro picture of how it's impacting really investments globally, depending on whether or not China reopens, how quickly that happens, and really what the Chinese government actually does here. And how strict they want to continue this policy, and to the extent it impacts things like supply chain and other markets, really like oil, like we saw today, and other ways impacting supply.
Yeah. And China, it's remarkable. This is why I go back to the politics and whether political risk is higher. They chose to basically move away from the vaccines we were using here. They did not impose, they're imposing a crackdown on the country, but they didn't impose a crackdown to vaccinate people. That's what I find astonishing. It seems like they keep saying they're pro-science, and yet this didn't seem pro-science to me. It seemed more like somehow it's going to go away if we just isolate. It's not.
Yeah.
We know what this is like. It's extremely contagious.
Yeah.
The minute you open up, you're going to get big outbreaks now. And the only thing is to vaccinate the whole population as much and then keep developing better vaccines, it seems to me.
Yeah, that's, I think, the game plan is to move forward with promoting these inhalable vaccines where there's less stigma about getting a shot,
Wasn't there a nasal vaccine that was approved today?
Exactly. Sinopharm today, after the Hong Kong close, announced that they're going into clinical trials. We've already seen the CanSino inhalable vaccine got approved for use in Shanghai. Right after that, 10 more cities signed on. So there's clearly a path to making the more digestible vaccinations happen. And big push toward the elderly.
Yeah. Now, I want to switch gears for a moment. Bear with me here. We've all enjoyed the bountiful harvest of Thanksgiving the last week, and I want to talk about harvesting something else, tax losses. It's been a rough year. We've been talking about this before we went on the air, all four of us, for investors. Stocks down, bonds down, and a lot of investors have had big losses, particularly in technology stocks and tech funds. Tax loss harvesting allows investors to sell securities at a loss and offset those losses against capital gains taxes on other securities. So, Matt, give us some examples of how this. I had a discussion with you last week. You said you've seen some signs investors are using ETFs for tax loss harvesting. Explain how this might work. Give us an example of
Oh, yeah, definitely. So a couple examples. One is you have a mutual fund. You own a mutual fund that tracks broad-based U.S. equities. That is obviously down this year. Now, perhaps it's an active manager who's also down relative to the benchmark, so you're sort of down on both ends. That mutual fund might actually be lined up to pay a capital gains dividend because of the losses associated with the overall portfolio. And what you can do is you can, at this point in time, sell that mutual fund and then buy an associated ETF. And therefore, you're able to maintain your market exposure and harvest those losses in some of the areas of the marketplace. Yeah. So I think that's one of the areas that we've seen. And then you can also see it within just ETFs in its own right. So again, selling broad-based equity exposures and then buying back into another ETF that covers a very similar marketplace. And I think on the mutual fund side, the biggest way to sort of point towards this type of activity is that we've seen basically about $750 billion of outflows in mutual funds, while you've seen roughly about $600 billion of inflows into ETFs. So you can start to see some of that rotation where...
I want to get that number again, because it's been remarkable. We're getting inflows still this year, but 700 billion outflows from mutual funds, more than 500 billion inflows into ETFs. So I guess the question is, where's the money going? Is there any, on the topic here, is any of this money potentially due to tax loss harvesting? Is some of this?
Yeah, I think some of it on the face are from tax loss harvesting. Some of it is just the acceleration of the great migration out of mutual funds and into ETFs from a tax efficiency perspective, but also from a cost efficiency perspective. But I think when we look at it, you see roughly about 60% of all flows into ETFs this year have gone into very low-cost ETFs. And I think that's a very clear sign of some tax loss harvesting motivation.
But that's been going on for years.
It has.
That's just macro trend in ETFs.
It has, but I think you've seen an acceleration of it this year because those low-cost ETFs have taken in more share flows this year than they did in the last 2 years individually. The other big thing is that one of the tactics that we see utilized within clients' portfolios in tax loss harvesting is to just lower your costs. Lower your costs, go into a lower cost exposure, harvest some losses, and maintain that allocation into a market exposure like U.S. equities, like emerging market equities, as we've just all discussed. China's down big. China's a big part of emerging market equities. In emerging market equities, we've seen anecdotally from our clients and what their motivations have been, some big tax loss harvesting trades out of competing emerging market ETFs into some of ours.
So, Ben, not only has it been a rotten year for stocks, it's been a rotten year for bonds, too. We've seen outflows in bond mutual funds, and I have $154 billion into fixed income ETFs. I think you gave me this.
Yep.
$446 billion out of fixed income mutual funds and rising. And here's another example where potentially there's tax loss harvesting.
Yeah, fixed income actually is the really big story. And this trend is something that we've seen accelerate. And certainly the outflows out of bond mutual funds present some opportunity for investors, again, not just with equities, but also in the fixed income arena as well. And we've seen this structural shift, again, out of mutual funds into ETFs. And part of that is because of the losses that we've seen this year in the bond market have accelerated some of that selling. And then again, the structural shift just generally for investors' preference towards the ETF structure, creating those opportunities. And so we think, some of that really is around harvesting losses. Some of that also is around repositioning the investor's portfolio as well. So it's not simply about just harvesting your losses. It's the right time of year to take a look at the portfolio that you have and understand how to position yourself, in these markets. So I think it's a double-edged sword there.
Speaking of double-edged sword, it's like a triple-edged sword for mutual funds. This is just a horrible year for mutual funds. Not only are they down, as you said, most active funds underperform their benchmarks, so they're underperforming there. Then if they're an active fund, they might also have capital gains. I'm waiting for this disaster to emerge from some active mutual funds hitting, some of these people with what? Wait, I'm down 15% and I have how much in capital gains? What?
Mutual fund investors are in for quite a nasty surprise. And a lot of the mutual fund companies have already provided estimates on their website, so investors can take a look and see what their expectation would be around the capital gains and what kind of tax bill they're going to get at the end of the year. So from a tax loss harvesting perspective, the time for investors to act actually is right now. Because at the end of the year, whether it be January or February, by the time you get that bill, it's too late. So in order to take advantage of these opportunities, it's something that needs to get taken care of really before the end of the year. And that information is starting to trickle out into the market, typically on the websites and through many of the major market data providers.
And for people, again, this is that educational moment to explain to people the difference between ETF and a mutual fund. In a mutual fund, you may have active managers making trades that result in taxable events. But when you're buying and selling ETFs, of course, it's a different situation. You might want to, could you explain that to everybody, the difference here? This is that teachable moment here.
Yeah, so within a mutual fund, if I was a holder of shares of a mutual fund and I would redeem my shares, the portfolio manager would go have to sell securities to fund that redemption order. In ETFs, very simply, the creation redemption mechanism takes place in the primary market, and I'm trading my shares in the secondary market. So I'm selling my shares to a market maker, and then they are redeeming those shares from.
And that does not create a taxable event.
That's not create a taxable event because those transitions are usually done in kind. So it really limits the sort of taxable events within the ETF structure. And that's why, on average, historically, over the last 10 years, only about 6% of ETFs historically have paid cap gains in a given year. Conversely, mutual funds pay about 60%. So about 60% of mutual funds pay capital gains in a given year, both active and passive, but on the majority side, on the active side. And I think in 2018, what we saw, because that was a year where both stocks and bonds were down as well, we saw roughly 35% of all mutual funds have this sort of the three true bad outcomes. They were down relative to the benchmark, and they got levied with a capital gain. And that's a significant amount of assets in the numbers of trillions with a very big capital.
Now, by the way, you're talking about redemptions here, but if you have an active fund manager in an ETF wrapper, you can still have situations where they generate capital gains because they're trading.
It's much less. So historically, active ETFs, they roughly, I think, somewhere in the neighborhood of like 10%, high single digits, perhaps of percentage of pay capital gains dividends in a year. Because what happens is, not every trade has to go through the primary market. We have some funds in our lineup that have very robust secondary markets where you can trade $200 million worth of shares back and forth and never touch the primary market where it leads the PM to have to trade securities on buy or sell side.
Yeah.
And that speaks to the benefits of ETF from an ETF tax efficiency,
You're just
but also
buying and
liquidity.
selling the ETF, not the underlying, and that's
Correct.
the key.
That's the
I
big
know
deal.
we've been a little bit abstruse here, but it's important to explain to everybody exactly how this whole thing happens. And I appreciate everybody. We were going to talk about tax loss harvesting exclusively, but the China events over the weekend made us switch gears a little bit. And thank you, Brendan, for joining us on such very short notice. That does it for this week's ETF Edge. My thanks to Brendan, Matt, and Ben. We've asked Ben to stick around and talk about this brutal year for investors, particularly in bond ETFs, and how investors are repositioning for the ETF Edge podcast. That's coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.